How much do I need to make to qualify for a mortgage? It's one of the most common questions I get, and the answer might surprise you. You don't need to be rich, but you do need to understand how lenders look at your income, your debts, and your job history. I'm Mike Romano with Cornerstone First Mortgage, and in this video, I'll show you exactly how to figure out if your income is enough to qualify for a home loan in 2025. Let's dive in. Let's define what counts as income for mortgage purposes. Lenders want to see verifiable, consistent income. That could be W-2 income from a full-time job, 1099 income if you're a contractor, self-employed income from your business, Social Security, pensions, alimony, or disability, rental income if it's properly documented. The key is the income must have a history and a reasonable expectation to continue. So if you've been at your job for less than 2 years, or if your hours or pay vary, that doesn't mean you're disqualified, but we may need to provide extra documentation. Here's where most people get confused. It's not just how much you make, it's how much of it is already spoken for. That's what we call your DTI, debt to income ratio. DTI is the percentage of your gross monthly income that goes towards your debt payments, including your future mortgage. Let's say you earn $6,000 a month before taxes, and your car, student loans, credit cards, and future household payment total $2,400 per month. Your DTI would be 40%. Most loan programs allow up to 43% DTI for conventional, up to 50% to 55% for FHA and VA with strong files. Want a tip? Lower DTI means stronger approval and often better pricing. What if your income isn't the same every month? If you're self-employed, commission-based, or get tips, bonuses, or variable pay, we'll usually average your income over 2 years. We'll look at tax returns, profit and loss statements, bank statements in some cases, and if your income dropped last year, we'll likely use the lower number. Bottom line, we're looking for stability and a pattern we can count on. Here's a simple formula to see if you're in the ballpark. Take your gross monthly income, multiply it by 0.4. That's your estimated total allowable monthly debt. Now, subtract any current obligations like your car loans or student loans. What's left? That's your potential house payment, including taxes and insurance. Now, that's not exact, but it'll give you a rough idea. Want a better answer? Let's talk. We'll run the real numbers for free. The takeaway? You don't need to earn 6 figures to buy a home. You just need to understand your numbers. If you're unsure whether your income qualifies, click the link below and schedule a quick mortgage planning session. We'll figure it out together. And don't miss the next video in this series. Down payment versus reserves. What's the difference and why both matter in 2025? Be sure to subscribe, and I'll see you in the next one.